All right. Hello, everybody, and welcome to another Pepperstone Learn It Live webinar or live stream here on YouTube. I hope everybody's having a great day. My name's Thomas Atkinson. Today, we're going to be talking about trading FX majors, a super exciting topic that both Tyrone and I are very passionate about. It's where we really ground out those hours in terms of technical analysis. Tyrone, how are you going this week?
Yeah, good, thank you. Yeah, look, the majors sometimes seem boring to some, but actually that's where you're really going to probably make the most amount of money when you're trading properly. So they're really, really good to understand, and we're looking forward to sinking our teeth into it. We haven't done the majors or focus on the majors in quite some time, so we're looking forward to actually getting into the market and seeing what we can identify.
Just a quick reminder, we've got a quick risk disclaimer. We'll just chuck that on the screen right now, Ty. If you could just pay attention to that.
Very important.
Yeah. So thank you very much for bearing with us on that one. Obviously, it's important that you do understand the risk disclaimer. Before we get started today, Ty, there's quite a few things. Let's switch over screens here. Let's get into the presentation. And straight away, the Pepperstone Telegram group, YouTube you're here on, and of course, some of the live presentations we do. If you enjoy the content today, remember to subscribe. Also, if you can, give us a thumbs up. It does help us out. But realistically, one of the best things you can do is follow some of the Pepperstone live series, especially Chris Weston's one. He does a really special one for gold each week that's on Thursdays. I tune in every Thursday, Chris, if you're out there, and it's a great thing to get involved in. So make sure you check that out. That will be happening, I believe, tomorrow. And I think it's around 3 p.m. generally, Australian Eastern Standard Time. So if you're interested in checking it out, you're interested in gold, check out As Good as Gold on YouTube. You can also come and join us, obviously, over on our YouTube as well at FX Evolution if you choose. But firstly, Ty, let's get into the rest of it. Let's get into some of the things that we want to be talking about here. So this is a bit of a beginner's session, but I think intermediate and advanced traders will get a lot out of this. We're going to focus on price action. We're going to focusing on understanding the psychology of the market, the importance of the different time frames, and even if you're a scalper, a day trader, or a swing trader, you're going to get a lot of value out of what we're talking about today. And we've seen some very critical levels being reached over the last couple of weeks, haven't we, Ty?
Yeah, most definitely. The markets are really playing the game in terms of scalping and probably in like day trading and probably even short term, couple of days swing trading. So I think we can definitely look at some good levels. And I think, and it's the majors that are doing it too. It's not like the majors are being slack. The majors are the ones that are actually leading the way. So it's going to be good to get a bit of an idea of where these levels are and probably more importantly, how to trade them.
Yeah, the majors have hit some really key levels, big turnarounds, big stories here on DXY as well, the US dollar, and something that I think a lot of beginners often overlook with their live chart analysis, which we'll be going into very shortly. And of course, key entry points, time frames. How do we find these key areas? How do we get the confidence to hold our trades? I know a few of you out there have probably traded and you've let your losers run, and of course you've let your winners be cut off very early because you may have no confidence in the trade. And look, we were there, we've done it before, haven't we, Ty? And we see many people in our mentoring struggle with this. So it's something that we really like to work on, and you need to understand the market first before you can get through that.
Yeah, 100%. Understanding the market, understanding price action and the buyer and seller sentiment is probably the most important thing there is when it comes to trading, short of risk management, really. So, and it might sound trivial. You think, well, how are you going to really understand what the buyers and sellers are doing? Actually, it's actually quite easily when you know what the candle structures are telling you and the bar structures are telling you. We will go into a little bit more depth on that a little bit later on. It actually becomes quite apparent what the market's trying to do, and it's really a case of just working with it at these key levels.
Exactly. Now, whenever we're talking about beginners and we're talking about just anyone in the market, understanding the news announcements, that's something that I feel like some people sometimes don't remember. It is imperative that you check the news announcements daily, especially in FX trading, where you're looking for, relatively speaking, quite small moves. And especially if you're scalping and day trading, if you don't know there's a reserve bank of that particular currency, such as the New Zealand dollar here, coming out with a rate statement, you're trading it on the 1 minute, 5 minute chart, and all of a sudden it goes 30, 40 pips in the opposite direction. You need to know why that's happening, and you need to, more importantly, be able to create risk mitigation around it. So make sure you've got an economic calendar. There's plenty out there. You can just literally search Forex economic calendars. And I think Pepperstone had one on their website as well that you can check out. And I think there's one in the platform. So some good stuff there. Which trading pairs are best to start with, Ty? Another question I think we get daily about
Yeah.
FX majors, and it always comes down to the US major pairs, really the major crosses for the time frame that you're in. And I think a lot of people really kind of just go, I'm going to trade euro, I'm going to trade pound, I'm going to trade, yen, US dollar, yen, but they also don't think about the time frame they're in. If you're someone that's from Australia or the Asian area, then basically you may be wanting to look at Japanese yen style trading. You may want to look at the Australian dollar, the New Zealand dollar a little bit more, while still focusing on, of course, gold, euro, pound. Whereas if you're a London, Europe-based trader, European-based trader, you may want to focus more on the euro crosses, such as euro, pound, maybe as well the pound odd, pound US dollar, euro US dollar, etc. It's a very important decision, isn't it, Ty?
It is, yeah, and really mastering the one that you are going to really focus on is a really big deal. And a lot of people probably underestimate that. You think that you need too many different pairs to make sure that you're capturing every single move. It's not really the case. The idea is to actually get a basket of pairs and commodities or whatever it is you want to trade, and actually have a really intimate relationship with them. And if you do that, you understand the moves, you understand the cycle. So it's really about understanding what the expected move is, probably just as importantly as where you actually are going to trade, because there's no point, trading and saying, I want to make 150 pips from the Euro USD, when in actual fact it only moves, 30 or 40 pips in a day. And if you know that, you're not going to expect, ridiculous things out of it in a very short space of time. Whereas the more exotic pairs can have 150 pips in a day and it wouldn't even be unusual. So it's really, really important to understand their movements. Very, very key to actually knowing what trades you're going to actually place for particular currency pairs, but also understanding what the average is for those movements.
Understanding the pair, key pivotal thing. I'd almost write it down. Focus on a smaller, don't just open yourself to 50 pairs straight away. Focus in on the ones, understand them, become, as Ty said, almost intimate with these pairs. It's very important. And we often found that I think what happens, we found frustration sometimes, Ty, in our trading, and then we ended up going into other pairs, and then we always came back. So take it from us. One of the best things to do is to focus in, become best at your craft. And it's like anything, like a profession, really. You want to be the best at what you're doing. And if you are, then you rise to the top.
Yeah.
Another decision we've got to make. What
100%.
type of trader are we?
Oh, yeah.
Yeah.
One of the most important decisions, and it's also, this does come down a little bit to understanding the time frame that you're in, also understanding the market movement, but understanding your pairs. That all ties in here, because like I say, if you're scalping something a little bit, let's call it ambitious, like cable or one of the really exotic pairs, if you're scalping, you've got to really allow yourself, probably decent stop losses to begin with, because those pairs move, 10 or 15 pips in a heartbeat. You can put your stop loss in at 10 pips, and you could be up before you even turned around to see the other screen. It's happened. We know, we've tried it. Whereas if you're doing a scalping trade on the euro, you can have far more realistic stop losses and expectations of what it's going to do. So it does come down to it, but also understanding, if you are a swing trader, that you are going for the moves that a swing trader will go for, not just, a swing trader is not going for 10 or 15 pips, right? Like, make no mistake. That's a dead set scalper. And if you trade a swing trade like that, you're going to get stopped out more often than not, because you require a bigger stop loss. Every one of these trades requires very different stop losses. And I think that's why it's important to understand which trader you're going to be. Now, everybody at the start begins being a scalper. Like, that's we're very in tune with that. It's common because people want to spend time in front of the charts. They want to learn. And ironically, a scalper probably has to do more work than a swing trader and a day trader, or even a intra medium term trader, because they have to stay in front of the charts all the time. They've got to be really focused. The discipline has to be really, really, really in tune with what's going on. So as much as it's the first place that everyone starts, it's actually probably the hardest place to trade, isn't it, Tom?
Yeah. I was just thinking about then. I actually wrote up a few hours. I think the scalper is probably it's the hardest trade, because there's a lot of algorithms out there. There's speedy. It can be very bad on your psychology as well if you don't have a strong system. And I think that's something and a strong understanding of price action. You need to know what's going on. Day trader, obviously, still very time intensive, and then swing trader, the least time intensive. You may only need to, I wrote there, about 45 minutes a day. If that's serious, you may actually need to do very little analysis on the charts, lot less risk, lot less news kind of stuff. News. If we were going
to label those three, we would be saying that the bigger one is the beginner, the medium one, the swing trader is the intermediate, and actually scalping is advanced. Trading level I'm talking about. So that's how we would label it. And yeah, we've mentored hundreds and hundreds of people and taught thousands of people how to trade. So we've seen it all. And I can assure you scalping would be in the advanced category.
It is very much advanced. Let's just quickly go into something that I think is really important. This is actually a section taking out of our course, and it's just the beginning section, and it's just talking about candles and bars. And I think I want to start here before we get into the live charts, which we will be in very, very soon. And because there is a very important lesson there. Now, we all know this. I mean, most people are going to come into learning. They're going to learn what a candlestick is. They're going to learn what a bar is, what a line chart is, all of these types of things, Ty. We've got the open, we've got the close, we've got the high, and we've got the low, right? Pretty simple stuff. But all of this information about what this has just done over that time frame conveys to us a really important message. And we always say that if you look at the left-hand side, it's going to show you a compelling story towards either strength or weakness, and of course, consolidation. And most people think of patterns. They think of a double bottom, a head and shoulders pattern, a flag, all of these types of patterns. They think, oh, I found a flag. I'm going to trade it. This particular cheat sheet shows me how and shows me where my profit's going to be. And that's all well and good. But how compelling has the storyline been to create that pattern? The pattern itself is less important. What's important is the storyline or the psychology of the market, isn't it, Ty? How is it
Definitely.
formed?
Absolutely. And what we talked about earlier is this is the exact thing that we're talking about, understanding the dynamics between the buyers and the sellers. Those 4 pieces of information, the open, high, low, close, tell you everything you need to know about that particular period. Now, that might be a day candle, it might be a 15-minute candle, but it's all relative to what you're trading, right? So if you are trading on a daily chart, then the daily candle is the most important information. So realistically, it tells you everything you need to know about the market sentiment. Now, we understand we look at candles and we know exactly what they're trying to tell us. So, it's easy for us. But what we've done in our course is applied percentages. So you can actually break down, take away all of the ambiguity about what is a long range candle, what is a short range candle, and actually breaking it down to understand exactly what it is. I mean, clearly the buyers are in control there. Clearly the sellers are in control on the red one. We've got hammer candles, same deal. The hammer candle, just because it's got a fancy name, that's not what the candle is actually about. It's actually telling us everything we need to know about a very, very big decision that's been made in the market itself. Okay, so let's look at this one for an example. You can see here that the open started quite high. And then what has happened is the sellers have completely tried to take this all the way down, like a very, very big move has happened. Now, it doesn't matter, again, whether it's a 15-minute candle or a daily candle. For that particular period, the sellers have been in total control of that at some point, and it looked like it was going to be at some point a very, very bearish candle. But prior to the close of that candle, the buyers have completely reversed everything the sellers have done, and they've been able to close out that trading period, again, no matter what time it is, higher or at around the open of that particular candle. So they've basically undone everything that the sellers have actually put in. So the buyers are well and truly in control, and the momentum has definitely shifted inside that candle. So it's a very, very important thing. And we get that with only 4 pieces of information.
We get this story. We get the beginning of the story. Now, there's almost all these different things we can come in. We haven't even discussed what time frame it is. This could be a daily. Is that going to be more important, the discussion here, than the 1 hour? Yes, it is. More people are going to see it. We need to then start to think about where that price has happened. Has it happened at a psychological point? This may be a beginner session, but this is the essence of trading that everyone overlooks, and we did, and everybody does. They skip right past and they go straight to the cheat sheet with the patterns. They skip right past and they don't understand the market. And we were talking to some pretty knowledgeable people in technical analysis the other day, Ty. These are guys that were dot plotting back in the 60s and 70s. They were literally taking the spreadsheet for the day in terms of the prices, putting it onto the charts. And everybody there, they all come to the conclusion that understanding the psychology of the market and actually understanding each bar and what they're telling you is the essence of making better decisions. It sounds simple, but when you know it, when you think about it, it makes a lot of sense. And you get that light bulb moment and you go, yes, this is so much better. So Tyrone's broken down a hammer here, or some people call it a pin bar. People call it all sorts of things. In essence, it's a bullish style candle. It's basically showing us that there's some kind of rejection. Now, if that rejection happens in the last 2 minutes of of the candle, let's say it's a 1 hour chart and it happens in the last 2 minutes and it goes all the way down here to here, probably going to be news related, but it is still a locked in time change. And remember, these things, once you've closed the candle, the closure is the key. That's the confirmation. What you were looking at 2 minutes before, what you were looking at 5 minutes before the candle closed, we've all been there, can look very different. And when you explain it to your friend or partner or whoever, I took this trade for this reason.
Yeah.
Okay, I didn't know what I was doing. I made a mistake,
exactly.
But you don't want to be doing that.
And probably an important element of that is don't let the color actually deceive you as well. The color of the candle makes no difference. It's all about the price action. So even though one is red and one is green, all that is representing is that the buyer and the seller open and close was just a little bit higher or a little bit lower than the previous one, but it doesn't actually take away from what actually happened in that candle, which is 80% of that move was reversed. And that's this is, again, we apply a very important percentage here. And this percentage, we put in a lot of research and a lot of testing to make sure that these percentages are as accurate as they can be. And we are very, very comfortable that these are the percentages that we know work well with these particular candles. So a lot of people associate that with bullish, and the red one is bearish. Both of those candles are representing the exact same thing, that the buyers took control and definitely have full control at the close of that particular candle. Very, very important.
Difference between theory and reality, Ty. It's the same thing as we see it. The only difference is that, remember, you've got to think about that psychology. So break down this a little bit more. Let's see if we can go through, see if everyone gets this one.
Yeah. Which one are we talking about?
Oh, no. So just in terms of breaking it down. So we break it down 20%. We obviously push that through. But remember, it doesn't matter whether, yes, okay, the open and the close, ideally it's like this, but it could still be the open and the close.
Exactly.
It's all about the 20%.
Yeah.
It's all about saying, okay, the story is still very good.
Yeah.
Then you start to bring in your support resistance. There's also another.
All we're saying there really is that as long as the open and the close is within the top 20% of the range, it's a hammer. That's all we're really saying, regardless of the color.
We've got Edwin here with a question about the yen. We will be looking at the yen, such a very important case study of something we want to talk about today with top-down analysis approach. But Ty, do you want to just go through this particular chart that's in the course? Because this is actually almost every scenario you can see in terms of single bar candles and bars.
This is actually one of my favorite parts of the course, actually, because these 9 candles that you see there, or bars, which they're basically representing the same thing, tell you every single situation pretty much that you'll actually encounter in the market. It can all be brought down to actually 9 particular setups. And you can see here, the very first one is just a big green bar, because that's the opens down the bottom and the close at the top. Just a simple long range bullish bar. The one directly below it is the complete opposite. As you can see, we've got the close at the very bottom, the open at the very top, very bearish. Now, they're the key ones that you're going to look at. They're the ones that have got complete momentum in one direction. But the other 7 candles there are really telling us everything that you need to know that can happen in between. So you can see here at the one on the in the middle top, the buyers had control. But they did lose momentum towards the end. They weren't able to finish it completely at its high, and the sellers kicked in and took a lot of momentum away from the buyers. That's a very indecisive sort of finish. Then we look at the one next to it again, and the buyers had complete control at the start, took it all the way to the very top. The sellers completely overwhelmed the buyers by the end of it and closed it down below, which is the opposite of the hammer that we were talking about there, which is effectively either a shooting star or it can be one of the gravestone dojis that we have got in the course. But all in all it means is that the buy at the open and the close was actually closed within the bottom 20% of that complete range. So all we're taking away from that is the sellers completely overwhelm the buyers. So that bodes very well for the sellers on the next candle. Okay, and that's what we're trying to establish. That's why Thomas said, we're always looking to the left to find out what's going to happen on the right, because that's all the information we need. Now, we'll go to the very last bottom corner one. That's a complete indecision candle. You can see here that the buyers had control for a period, the sellers had control for a period, but at the end, they basically finished right in the middle, so no one actually won the day. That's what we call an indecision candle. Now, one thing about these candles, it's one thing to know exactly what the buyers and sellers are doing, but these candles in the middle of nowhere don't effectively mean much. It's all about that a little bit in the live analysis we're going to do shortly. But yeah, realistically, I mean, the course explains all that, of course. Like candles in the middle of nowhere mean nothing, but in strategic points or at support or resistance, these candles are everything, and they're so important.
All right, let's bring up the live charts that you were just talking about there, Ty. We got a question here. Says Don says, "Hi Tom, Tyrone. I understand it is vital to know the buyer/seller dynamics in the FX. All bars you are showing indicate price action. Question is, how do we know what the next move is, long or short?" Well, this is where you bring your analysis of these candles together with your then knowledge of psychological prices points, and then of course support resistance. When you start to put these candles in the story together, which is multitudes of different candles together, you start to get a very good idea of where the market is going to start to find weakness, where the market is going to tell you a story. So let's use a couple of scenarios here to actually answer that question. We'll also talk about the yen as well. We'll start off with the DXY, Ty, and I think this is a very important one. Let's go what we call top-down approach. So let's start off, we'll talk about the weekly. So the weekly is obviously a very high time frame. This is where Wall Street and plenty of large hedge funds and big banks, they might be making big long-term decisions. For most retail traders, they won't start here. They certainly won't usually trade here. It's just too long. A weekly can take months and months and months to play out, can't it, Ty?
Oh yeah.
So it's a little bit too much for them. But the thing with this is what we've got is we've effectively got a great support level. We've got a great resistance level. And we've seen a breakout that's now coming back up to this new kind of resistance. We've clearly got some key zones, and we've got them all highlighted here. These are all the most important support resistance zones from the way that we see them. Now, we take that through closes and previous touches and also the current price and how it's been interacting. But the weekly is a great place to start in Forex, and it's what we usually do with the top-down approach. So let's think about that question we just had then in terms of the story so far. We've gone up to this resistance. Now, we knew that was going to be resistance before it hit because it's been resistance in the past. It's a highly likely area of interest for price action. We then get a rejection wick. We get what we call a long leg doji, which is effectively an indecision candle. So we have a high, we have a low, we get another rejection style candle, and the price comes down to the previous support area and finds a base. This gives us a good level because what we've got now is we've got a price trap between 94.50 and 93.50. Funny it would be a 50-cent increment. Basically, we've got literally, what is it, $1 effectively in the middle, and we're looking for price to break either way in terms of getting out of its consolidation. And potentially now we can start to say, okay, well, if we're trading, if we're looking at long positions, where might we start to think about take profit, exits? Obviously this is an educational stream, but this is just the way that we look at it. This is all done in the weekly. We can get a bit of an idea of key resistance and supports. How important is that, Ty?
Very, and then you've got the bias of where you're going to. So I think a lot of people get lost, especially when they're first starting out, in where are they going to aim for, where are they going to put their stop losses. But when you do draw these levels, even on the weekly, although it might not mean much to you because that's not the time frame that you're going to trade, it gives you all you need to know about where the recent price action has been and where you should be aiming for. So it's really important.
So if we have a double bottom pattern on the weekly, for many people, they'll take this, or many banks, many hedge funds, many longer term approaches, they might take this distance and say, okay, a double bottom pattern theoretically will therefore move to the next level, which is going to be based on the actual length of the double bottom, or the distance between the intervening peak here at the bottom. So if we get all of that, it gives us that longer term kind of, I guess you would say, resistance, support, trend analysis, thought process. Then we go into maybe a daily and we start to say, okay, well, what's the price action doing here? And you'll notice there's some rejections. We've got a rejection wick, a little bit of buying, a little bit of buying, a little bit of buying, a little bit of buying. Notice that wicks continue to come off that 93.50. Obviously, someone's looking at buying it here because every time it gets down there, it's not sitting there with a closure on the daily, it's getting bought up. And before this even occurred, we can see that. So this is, again, understanding the left-hand side. It's maybe more advanced in some ways, but hopefully for beginners, they start to get the idea of this is the type of way that you want to interpret the market. We then go down to the smaller time frame, such as a 4-hour. And you'll notice, again, even more things. So you might have something here like we might have a little bit of a trend line that you'll learn about. That trend line had been consistently making a series of lower highs, effectively in a downward trend. Then because we had that daily looking like it was finding rejections, we get that strength of base and it breaks through with a big almighty candle. Very significant candle this is, isn't it, Ty?
It is very, very important. And again, although it doesn't, one thing you need to remember as well, we probably haven't really highlighted it, but it doesn't matter what chart you're looking at. The price action is actually telling you the same story. It doesn't matter whether we're looking at the dollar index here. It doesn't matter whether we're looking at the Euro USD or the Aussie USD. You don't have to actually change your interpretation of what the price is telling you for the different pairs. Okay. So that's a really, really important point.
Correct.
But again, you can see that's come off a very, very strong base. It's pushed very, very heavily up, and it's broken a very, very key point of resistance already, come back and retested it, and now it's sitting above the moving averages. Very, very, very important zone. And yeah, I think to help answer that question that we had earlier, that's what the next move is likely to do, and that's why we're looking at the price action to give us the opportunity to try and pick the next level. So, and actually, it'll lead on to a question that we've got a question here from Angela that she asked. We did answer this earlier in the webinar, Angela, but I'll just quickly repeat it. She says that is it good to start with just one pair when she first starts, or look for multiple pairs? Now, look, it really comes down to how long you've been doing it, but there's nothing wrong with starting with one pair when you're absolutely starting. You can really get intimate with that pair, really learn it, learn its movements, learn its ranges, and then you can start, definitely exploring a few more options. But we highly recommend that if you are going to do that and you are just starting out, to stick with one of the absolute majors, that being either the Euro USD or the Pound USD or the US dollar yen, one of the absolute mainstream ones that have very, very strong liquidity, very, very steady movements.
Yeah, liquidity is very important, and that's why we stick to those majors. I think DXY is also very good with the euro. If you look at the dollar index and the euro, the dollar index is predominantly made up in terms of how it correlates to the euro US dollar. There's most strength there, and that would be probably a good little combo to start off with your analysis. And then of course you can bring in the pound, US dollar, gold, those kinds of things. Yep. Let's take a look at DXY here again. Just so we've got that 2050 cross. We're obviously seeing that strength. So with our top-down analysis, what you end up doing is you end up finding very important zones. And you might say, well, this isn't relevant to me. I'm on the 15-minute chart. Why do I care about the weekly? Because when you find these very important levels of resistance, these areas, you can then target those areas based on your smaller timeframes. Remember, you don't want to be necessarily buying right here, because if you're buying right here, there's a level of resistance over on the left-hand side. It's that story that's showing you, okay, well, a lot of people will be buying a 1 minute, 5 minute, not caring the world about what's around. But the smarter, kind of more advanced trader will be saying, okay, once that level breaks, there's a higher statistical likelihood it'll move to this zone based on my analysis. Obviously, this is educational stuff. So this is really the essence of what it's all about. Learning these resistance, these support zones, and of course, bringing together the story of the candles. We saw that daily, the rejections. Now, we had a question before about the yen type, and this is another top-down analysis, really great story. So if we think about the resistances and the supports, that have been recently found, see how the yen actually gets here, then it rejects down a little bit off that level. Clearly a level, once, twice, 3 times in the past. What's the most logical next zone? We talked about it literally for the last 2-3 weeks, actually. And this is the 114.50 area. Why? Because on the left-hand side here on the weekly, it's a very key zone. This is why it pays to look at the higher time frames. Again, you're on a 1 hour thinking that's going to keep going long. Where are you going to say, whoa, we've got to pump the brakes. We now need to see the price action and what happens. It's going to be around that 114.50. And as we speak, there are certain things that we talk a lot about in our course, Ty, to do with, lightning bolts, effectively peaks, troughs, lower peaks and lower troughs that could really change the trend here and push US dollar yen back down to the 112. And it's not going to happen yet from a technical perspective as we see it, but there are certainly signs that point towards the weakness here and further weakness.
Yeah, absolutely. And I think, look, you can probably ask of every 1,000 professional traders out there who traded the USD yen, you can bet your bottom dollar that probably 99% of them were taking all profit or definitely significant profit at that 114 and between 114.50, knowing that resistance was there. Professional traders will not trade into that and expect it to go longer in the first hit. They just don't. They're aware of those levels. And if you want to get to that level yourself and start understanding the market, you've got to map them out and understand those as well. It's a very straightforward process, really. I think support and resistance is actually the easiest thing to learn in technical analysis, actually. So
yeah, exactly.
definitely, it's definitely one of the ones. And it's amazing how many people don't do it. I think that's probably, you know, it doesn't take very long, especially if you're doing it on a weekly chart. You only have to probably touch them up every couple of weeks, but they give you so much information, especially for targets.
All right. Another thing that I think is a great question here, and this rings true to right now, Ty, is it's from Dab G. And he says, "Hi, guys. Sometimes I struggle with picking breakouts. I correctly identify them, but they are often false breakouts. Any tips on when to pick strong breakouts?" Well, this actually comes down to understanding the left-hand side. And there's actually a good scenario here with when to look at good key breakouts. There's a few things that are good about breakouts. Usually, when they're going to be false, there'll generally be a couple of tells. One of those tells is maybe there won't be as many previous resistances, or you won't necessarily look at the right confirmation. So remember, if we have, let's say over here on the left-hand side, we've got 1 touch, 2 touches, 3 touches, 4 touches, let's say, then we break out. What time frame are you breaking out on? Are you breaking out on a 5-minute coming into a London Open? Are you breaking out on a 15-minute? Are you breaking out on a daily, a 4-hour? As you go up the time frames, the less likely it is going to be a false breakout. But there's another little tip that I guess we'll give you here as a beginner, intermediate, and advanced, and that is when you're coming into a potential breakout zone, think about this most recent price action. What's it telling you about price? Here we have a series of higher lows, and what that is hugging that 20. And what that's telling us is that each time the market rallies coming into this, it fails to go down very far. It gets bought up again, and then it fails to go down very far. So because it continuously makes a series of higher lows, what that's showing us is there's some kind of momentum, there's some kind of instinct the bulls are having here. They want to be in, they want that price, they want it now, and they're not prepared to let it go back down. It's the same thing with patterns. Sometimes you look for this in patterns. On a head and shoulders, the right shoulder should always be smaller than the left, ideally. But if it did this and then broke through, is this going to be as strong? Most likely not. So remember, if on the left-hand side we've got a series of higher lows or lower highs coming into it, it's showing you a good first sign that that breakout may be less likely to be false. What do you think about that one, Ty?
Yeah, most definitely. And momentum is everything. When you're approaching a key level with momentum, like as this one is here, you got to think of it like, let's pretend there's a straw wall. Okay, so there's some straw bales, and they're making up a wall, and you've got to somehow break through that. Do you think your chances of breaking through that are standing right next to it and leaning against it? Or do you think that if you had a bit of a run up at it and you ran at it and gave it a big hit, it's got more likelihood of actually falling over and getting through? It's exactly the same way with price. If price hovers around that resistance too long and too close to it, there's not enough momentum from the buyers to actually break. When you can see that pattern where it's actually coming up and making higher highs and higher lows from below, it's actually approaching that resistance, that brick wall, if you like, with a lot more strength. And it's that strength that will actually break through. Now, breakouts can be difficult to find. They're not the easiest things to find, but understanding the clues is the important thing here. Understanding that there is required momentum to get through to make it a solid break.
There's another one here, Ty, that I think could have been hard for a lot of people to navigate, which is the beginning of this whole US dollar yen. See, some people think it started here. It truly started here, guys. And this is what we call a marginal break. Basically, where you've found like a very important level, let's say on the daily, and you're looking at it and you think, oh, is that really a breakout or is that not good enough? Sometimes it is better to either scale positions and have that as part of your strategy, or it's better just to wait for the confirmation. Let the confirmation come through. Are you going to get worse price? Yes. Is there a lot of potential in a trade like this? When you're doing the big analysis and you're looking at it, yes, there is. So how bad is it really giving away 50 pips or 100 pips? It might seem that is the stupidest thing I've ever heard come out of someone's mouth that was saying to me. They'll say, Tom, are you stupid? But really, the main thing here is you're trying to avoid the false breaks. So that's another thing. You can wait for that little bit of extra confirmation. And even if you wait for it and you think, oh, I've missed it now, it's a good chance it comes back for the conservative entry and lets you in. Patience is boring, but often underutilized, isn't it, Ty? This is a trade you don't take.
It is absolutely. And you know what? The best chess players aren't the fastest players. they're the ones that have got the best strategy. And trading is like that. You've got to be patient. The best trades are the ones that you wait for, not the ones that you try to actually jump on board. Not many good trades that you jump on board a moving train work out as good as the good setups. There's no question about that. There is a question in the room about which time frames and which moving averages. I'm not going to read it all out because it's like there's a lot there. But look, just to give you an idea, the only ones that we use in our analysis are the 20 EMA, the 50 EMA, and the 200 SMA. We use those on every time frame, whether it's a daily, 1 hour, 15-minute chart. We simply understand them and understand that the 20 EMA is probably the most important EMA there is. If you go lower, and I see here that you've got, there's an 8 and a 10 and a couple of very small ones. Look, it's not that they don't work, but they do require a lot more work. Thomas and I have made, basically a career out of doing as least amount of chart work as possible, right? I had to start.
You'll burn out, guys. You'll burn out.
You burn out. Like we did the 16 and 18 hour chart days.
Yeah.
The idea is to actually have a lifestyle, and what you want to try and do is actually reduce your time in front of the charts. Now, if you're going to stick to really small moving averages like 5s and 8s and 10s, that's going to require a lot more work. Now, the 20 is proven time and time again, really, to be the best moving average for us, because it's the one, it's really the mean reversion moving average where price gravitates to when it's unsure. And it often gives you the best pullbacks. If you had to, force us to pick one particular moving average that we can use, and that was going to be the only one, the 20 would be that moving average. So we don't really look any lower than the 20 because we know that's the one that we believe in the most. And as you can see, I mean, that's a perfect example right there. Look at every single touch.
This is the NASDAQ, and this is the power of the 20 on the weekly.
Yeah.
The 20 is an incredible moving average. It's number one, our favorite indicator out there. I couldn't find an indicator I like more, and it's just a simple line, Ty, based on 20 periods.
Yeah, and one you don't have to look at every single day. I mean, that's the thing. You know what it's doing. It's really, really important. So, that may not have answered your question exactly, because I know you've asked a few different ones there. But look, for us, the time frame, and if you want our favorite time frame, sure. That is probably anywhere between the 1 hour and the daily, really. The daily is the main time frame that we really, really pay attention to, because that's giving us the nuts and bolts of actually what's happening. But we do often trade the 4 hour and the 1 hour. Very rarely do we go less, and unless you're scalping it, then you can get to 15.
Yeah, and generally a lot of scalping strategies are based around opens and that injection of liquidity that comes around those times. When you bring up your volume, you'll notice volume spikes around that European Frankfurt Open into London Open. A lot of people trade that time for good reason. Liquidity is coming in, news is coming out. There's a lot of fanfare and a lot of fun for that first little bit, but you obviously need to target certain periods of the day. If you're trading after New York close, it's going to be a little waver thin band in some of the currencies. So the pound here, Ty, it's got an interesting story. Again, people ask us, how do you make better decisions? Well, you're always going to have a little bit of confusion in charts. That's the nature of it. You've got to be able to cut through that. But you look at the pound here and you obviously say, okay, well, we've hit a resistance, and then we've somehow got back to that over the last day. So the day before, today's trade, we went up and we fully rejected that zone, and in essence created a bit of a shooting star style candle, a rejection candle. That's come off the previous resistance. So a few things here. You're basically looking at it and you're saying, okay, well, why did that happen? Well, somebody wanted to short it, a change of news. Who knows exactly what it is? We can go and look into it if we want to. But we know that if it ever did close above here, incredibly now significant level because of this nature of the left-hand side. So if it fully reversed, that would be an incredible significance, and I think it would go quite long. And that we've now pressured underneath that, hit our first level of big support. So the resistance, the support, the 2050, and we closed underneath here. Where's the next level? The next level is most likely here. We're doing this from the daily scenario. Again, this is educational stuff, guys. But the main reason we're doing this is because then we can dial in on the 1 hour. We can dial in on the 15 minutes, the 4 hours, and say, okay, if it closes below here, we're looking for potential opportunities down to here. If it closes above here, we're looking for potential opportunities up to here. We're getting that bias based on our bigger time frames that gives us what we call a participation zone. And that's something a lot of, I think, beginner traders don't do. I know that I didn't go past a 15-minute when I first started, Ty. I didn't even know what a daily was. That wasn't a thing.
No, it was not a thing. It was not a thing.
It was 15 minutes, 1 minute, 5 minutes, and possibly a tick chart. But
Yeah.
I wish that I had known this then, and I had gone through the timeframes and put in that little bit of work of understanding where the market's at, where I believe the support resistances are
At some point in your trading journey, before you reach ultimate success, the daily will become your best friend.
Yes. I've never met someone that says nothing other than that. That's been around for a long time. And that's because the daily is the candle that everybody sees. Everyone wakes up in the morning, they check that close and they go, oh, okay, I see that. Everybody sees it, and just makes sense. If you're thinking about even trade desks, a lot of these guys or girls may work for 10-hour times, but they're not always going to be sitting there trading. They're going to be sitting there making decisions, doing calculations based on their strategies. It's algorithmics that really in the really small time frames a lot.
Yeah, that's right.
Now, another question about gold, Ty. Someone said, what about gold? Can I just trade gold? Gold tends to be an interesting pair that has, I guess, a lot of spikiness on it, and it trades very well, but it's very particular to certain times of the year. And I think this is another one for the top-down approach here, Ty. There are some interesting seasonals, aren't they, where things like gold have tended to run strongly at the back of that November into December. And when you bring seasonality along with your technical analysis, is another more of an advanced technique, but certainly something that some people use, isn't it?
Yeah, most definitely. And it's important to actually factor in. It's a little bit like, looking at the news events, really. Like, people don't actually take notice of what's actually happened in the past at particular times of year to see if something is weak or strong traditionally. So it's one of those ones where it definitely pays to do it, because what you don't want to be doing is not knowing about it and trying to short gold, say, in the first week of December. History will tell you over the last 6 or 7 years that you're going to have a very difficult journey. I would argue, and a very simple analysis will tell you that generally you're going to get a couple of very strong weeks out of December. So understanding those and plotting them and actually just remembering where they are and when they're happening is key. It doesn't mean that you're going to have to trade it, but it just does mean, though, that you're aware of it. I think it's probably the key. You've got to be aware of what's actually happening in and around that time, rather than, just going on your own and thinking, well, it looks short for no other reason than we've got a shooting star. So you've really got to combine your analysis with that. And I think, people become a little bit lazy when it comes to seasonality, but it doesn't take very long to go out to a weekly chart, plot a couple of months and actually see what it does. Because traditionally, especially in commodity space, you do get repetition a lot. And that's what technical analysis essentially is.
Yeah, and it's bringing these things again together, getting that story, and then making the better informed decision. So, Ty, I think what I wanted to then talk about was really, we know that candles are important. Which candles are people going to focus on the most in their beginning journey? So we've got obviously the hammer, we've got the shooting star, we've got the long leg doji, which is an indecision candle where basically we've got a low, a high, an open, and a close. And what that's telling us is that there's literally it's neutral. There's no decision made in the market at that period. When you get long leg dojis around key resistances or supports, let's say over here, there's a long leg doji, followed by another long leg doji, followed by a decision. What does that mean? Well, it means decision made, as I call it. I go crazy about this candle when it's at the correct level, because to me, the long leg doji is really showing you that it's an important level and that your technical analysis, your resistance or support level, if you found it there, is correct. There's clearly a war going on between the bulls and the bears. When they buy that and close above, or they sell and close below, they've made a decision. And if you find some other relevant reasons for your trading strategy to go along with that, you can definitely get in on better opportunities.
Yep. We're going to quickly go to a couple of quick questions so we don't fall too far behind them, because we've got a great participation rate tonight. Everyone's asking a lot of questions. Don asks us to give him a real-time tested strategy or formula that works to win a deal, long or short. As you know, it's impossible to learn and apply all in one. All right, look, the simplest strategy that we could give you that is time tested and you could go and look at it yourself is definitely the one we were talking about, which is a 20 moving average pullback. When you identify a trend and you see a series of higher highs and higher lows, and you trade the pullbacks in the direction of that trend, no matter what time frame it is, off the 20 moving average, that is going to give you a very, very good formula to create a good level of success. You only have to. It's battle tested because you can basically go through the last 50 years and you'll see how effective that formula is. That's why the 20 is so important. So, and that goes for the short side too. It doesn't have to be only long. If we're in a short trend and we're going making lower highs and lower lows, same deal. Trade up to the pullback of the 20 moving average. Very similar to what we see here. Understanding price action, seeing the lightning bolts happen, and then trading off the moving average in the direction of the trend. That is a battle-tested strategy that works. It's one of the most simple and effective. So that's what we can say to that one. And Korn asks, how would we enter a trade on the daily? Because you get up in the market and you already see a few hours in. All right, so we don't actually trade off the daily, Korn. What we do is use the daily for analysis. So we'll establish our bias and our direction on the daily, but what we'll actually do is go down to a 4 hour or 1 hour to actually enter. Okay, so the daily gives us our bias and it gives us our direction, and then we actually enter on a 4 hour or a 1 hour chart. So that's how that one works. We don't actually trade off a daily chart.
So here's the example. You have a resistance. Let's say it's 5 or 6 resistance highs, and then we break out. This can be used for both those strategies. So let's say we've got like a 20 moving average behind it. We've touched it once, we break out, we touch it again twice. Our theoretical take profit resistance idea is up here. That's what we call the participation phase. We've got 2 ways of doing that. We can say, okay, we've closed above. We're going to now look for smaller time frame trades into the participation phase, into where we think our take profit's going to be. And Tyron's mentioned before about the 20 moving average. One thing I'd like to add to that is a lot of times if you see 1 touch, 2 touches to that 20, again, in an area where the market's participating to the next supply or demand zone, what you'll be able to do then is you'll be able to follow that 20 along. And you'll find a lot of the time as it's on that ramping, it will follow the 20 moving average, whether that be on a 1 hour, the 2 hour, the 4 hour, the 8 hour. You'll find that reoccurring thing and be able to follow that. So yeah, it's pretty good stuff there. So of course, strategy wise, there's a lot of different strategies for beginners. There's a channel breakout strategy, what we literally just showed you, basically a resistance or a support and a breakout. You can look up channels. There's moving average trends with role reversal. That's another thing that you can bring into it if you want to, or just moving averages, find that recurring event. And then the channel markets, of course, channeling markets, range-bound markets, where you bring in your stochastic and your MACD. And we won't go too far into that because I think that goes past the beginner. We really wanted to follow on the price action today. But here's a channel, the buy, the take profit becomes the scenario of course, A equals B. So in this case, this distance here equals this distance here. You can splice that any way you want. If this is a daily, Tyrone mentioned 1 hour, 15 minutes, 4 hour. You can go into the smaller time frames and look for opportunities in your now biased direction of trend. So that's quite good. All right, chart patterns. Here's some different ones in uptrends. Obviously, the opposite to this in the downtrends. We've got a question here coming in from Stephen says, Stephen says, I use 20 EMA and 50 EMA on a euro US dollar. What is the right point for me to enter a trade or long or short with a 20 EMA cross the 50 EMA? I don't really love the crosses that much. I mean, crosses are significant, but I like to use them more as dynamic support or resistance. And you also will find that the crosses usually happen with patterns. So for an example here, double bottom, the cross will actually happen between a 20 and a 50 almost every time as the double bottom closes above, doesn't it, Ty? Almost every time.
Yeah, that's
because
right.
of the nature of the pattern itself.
Yeah. The longer term 20 and 50 moving averages, the crosses are a great way to establish a bias and direction. But I don't necessarily trade off that.
No.
You wouldn't want to be doing that really, because you've got to remember they are lagging for starters. And by the time they are crossed, you'll find that the market's actually pulling back and retracing a new level anyway. So you want to use them as a bias, absolutely. So you can use them as a directional move, but not necessarily trade off them, especially on a bigger time frame like a daily.
Dynamic support and resistance. That's the way we like to use them. Dynamic. And if you're wondering more about that, you can definitely check out our course because we talk about it in great detail along with everything else that we use. So if you guys are interested in it, you can check it out. We do have a special later on. That's probably the way I'd look at it. A few people asking, do we enter on 5 minute, 15 minute timeframes? Depends on the time frame that you've found to your resistance or breakout. Something like a 1 hour breakout, you may enter a position based on a 5-minute or 15-minute change of trend. That's probably when you're going to start using those timeframes. If you're scalping against an open, you may also use the 5-minute, 15-minute time frame and enter there. So strategies for the type of trader you want to be. Role reversal, we talk about this slide all the time. Resistance becomes support. The swing trader's best friend. This is what a swing trader will use. I love swing trading, but it's not always available in the markets. It's usually going to happen during the participation phase of a market, where a market breaks out heavily. We may see that in the DXY in the next couple of weeks. Let's find out. And then it'll become a swing trader's market, and that'll be fun. But overall, this is another kind of thing. We need to remind beginners, don't FOMO in the market. It's so important there, Ty. We don't want to deal with really any of these emotions if possible. Nope. Ideally, we're through the middle of the line. Boring is good. It's actually good in trading. Boring equals good. And unfortunately, emotions equals bad.
It does. Yeah. We've actually got quite a few questions asking us about going into the live charts and doing live analysis and showing real examples. This is a teaching webinar, but we actually do that in our live analysis webinars every Wednesday night. That one's actually starting in 10 minutes. So if you want to see live examples of what we're talking about in the real markets, just tune into that webinar that's starting in about 10 minutes. That's where we dive into the live markets and actually apply these principles in the real world.
Yeah, we've got the 1, 2, 3, 4 kind of strategy as well, Ty. If we have a really great resistance that is broken out, again, this is a great one because we have a series of higher lows coming into the closure, showing that significance. I know for a fact this went on and did the business, but there was a 50 EMA 4-hour here. Now, you can't see that. I mean, you could probably guess it based on the 200 to a degree, but yeah, there was one round here. You can see on the left-hand side, the resistance. It's very clear. This becomes an interesting level of participation that you could take advantage of on the smaller timeframes, 5-minute, 15-minute, etc. The top down, using the moving averages, using your theories, your concepts can be quite effective there. So wait for confirmation breaks. That's the most important one. And we want to always make sure that we confirm every one of our positions. 20, 50, and 200 are the moving averages we use today, which is really important. And we'll hand it over to questions as we finish up. But I did want to let everybody know that if you're interested, we do have, of course, a ultimate trading masterclass, which includes stock, Forex, everything really, technical analysis, all the way from the beginner to the intermediate to the advanced. And it has some systems in it called our Pressix system. We treat trading like a business, as you should too. It is real money. And obviously, you want to be making the best decisions you can. If you're interested, you can come check it out. And obviously, we have a private trading chat room as well. It's there. You can use the Pepper 500 code. And the reason why it's that is because you're getting 50% off. And you'll see when you go check out the website. So if you're interested in it, let us know. And we'll answer a few more questions before we finish up here. And hopefully you enjoyed the session. If you did, please give us a thumbs up as well. It does help us out. All right. The other question I've got here is, what is the attraction of trading US shares over FX? I realize there are a lot more shares to choose from, but that implies a lack of opportunity in FX. They're both great markets. It just depends. FX has many opportunities for a scalper, day trader, and swing trader, and there's always pretty large opportunities in the FX market. You'll often find the FX market's really hot when the share market may not be as hot, and then vice versa. US shares is what you've asked for here. Obviously, Pepperstone has those. They're both great. You've got to realize they're different markets. So Forex has no real value in terms of it's up and down all around. What I mean by that is the bears and the bulls, it can go off in a bearish direction, or off in a bullish direction, or off in a bearish direction very easily. With the share side of things, there is that inherent ability. You're buying a business that's trying to make more money when you're buying a share. So therefore, it is more bullish biased than bearish biased. And I think you need to think about that a little bit. But these are just the nuances to each type of trading instrument. Gold's obviously also seen as a hedge against certain things. Some people think it's a hedge against inflation. So it's maybe more biased towards the long side as well. You need to understand the instrument, don't you, Ty? And that's why when you're starting off, you focus in your lane. And obviously, if you started with Forex, you focus in on some currencies.
Stay in your lane. We hear that a lot.
Yeah.
I think it's the catch call of the coronavirus, actually.
Absolutely.
But yeah,
Absolutely.
absolutely.
Yeah. So, look, we hope again that you enjoyed today's session. If you did, please give it a thumbs up on the YouTube. It does help out the algorithm, and obviously, it makes sure that Pepperstone know that you enjoyed this content. Obviously, there's plenty of other content out there that we offer here on Pepperstone. There's the Good as Gold webinar or live series on YouTube that happens every Thursday. So you can go check that out with Chris Weston, and plenty of other material through the Telegram and obviously YouTube channel. If you want to join us, you can join us on FX Evolution in YouTube, and we'll be FX Evolution live, and we'll be going live in about 5 minutes. So thank you very much, and we hope you enjoyed the live session. Anything else to say, Ty?
No, Tom, can you actually post, a few people are asking for the link for tonight's webinar. Can you just quickly post that in if you can?
Try. Yep. 1 second.
Yeah, so that'd be great. Like I say, we do cover a lot of the concepts that we talked about tonight in the live markets. But look, in terms of the Telegram, though, it's one thing it's a free resource that you'd be mad not to use, because a lot of work goes into keeping that really, really updated. So it does a lot of work for you, knowing when news results are coming out and key market moves are happening. So definitely check that out. It's part of the Pepperstone service, so you definitely want to be involved in that. And Chris Weston's gold, or as good as gold, we watch it, and we don't watch many webinars. I'll tell you, Thomas and I do a lot of webinars and a lot of live events, but Chris's one is one we do watch every week because it is actually truly interesting, and he's an absolute expert in the field. So definitely give some time to that every Thursday. And if you don't watch it live, make sure you actually watch the replay. They're all on the Pepperstone channel, so you definitely want to get involved in that.
All right. Thank you so much, guys. I noticed here, Jason says, I'm up to module 2. You must have our course. Awesome, man. It really helps this webinar making even more sense. Thank you both. No worries, man. No worries, everybody out there. We hope you enjoyed it, and you can rewatch this right now after we close this stream off. So please do that. Learn the left-hand side, learn the price action, get excited about trading. I'm pumped, and I'm into this about 12 years now, Ty. So I may not look like it, but I've been doing it in a while. Thank you so much, guys. I'll just play the, I think it's the risk disclaimer again, and we'll see you maybe soon, or we'll see you in about 2 weeks. Thank you so much.
Thanks, everyone.